This is Jay Martin.
All right, welcome to the VRIC Media Channel, the most trusted voice in the metals and mining market. I'm really excited because today we're bringing on a new host to the VRIC Media Channel. His name is Darrell Thomas, and you may know him because for the last 4 or 5 years, he's hosted his own podcast called The Money Levels Show. Many guests that you would know, Frank Justra, Rick Rule, Andy Scheckman, Lynn Alden, dozens and dozens more, all familiar names. And he does a killer job. And I've been consuming his content and loving it. And we were both at Rick Rule's investment symposium in Boca Raton 2 weeks ago. And we reconnected, got to chatting. I shared a little bit about the vision behind VRIC Media and where we want to take this thing. And Darrell agreed to join the team. So he's going to be hosting content on the channel now. I'm super pumped, Darrell. It's great to have you on, man. I want to introduce you to the audience a little bit and pick your brain.
Yeah. Definitely happy to be on. Excited to be in this sector, be in this space, and even be working with you, Jake. So I've been consuming your content for a while as well. And I think that the way that you interview, the way that you extract information has definitely helped me grow in terms of my knowledge of this industry, the sector, and just overall financial knowledge. It has increased that. So I appreciate how your approach to this work has been as well.
Dude, it's so fun, man. I love what I do. And I'm stoked you're going to join forces here and be a regular on the channel. So I'm going to ask you a bunch of questions to get to know you in front of the audience here and introduce like how you think about the markets, how you think about capital allocation. I mean, the biggest criteria for me was honestly like, yes, you host great podcasts and you ask good questions, but you've got skin in the game. Like the VRIC Media is a channel built by junior mining investors for junior mining investors. I would never have a host on that channel who wasn't actively investing in the space. Jesse Day, one of our other team members, absolute killer, by the way. Jesse's fantastic and very active in the space, right? Like he's a very active investor. So, you can't, you can't fake it, right? So we jammed on a couple positions you have and how you're allocating capital and what you're looking at. Let me ask you kind of a tough question just to get us rolling here. And it's more of like a conceptual idea. So most Americans don't have cash to invest. I mean, that's the sad truth, right? I think nearly 40% of Americans don't have $400 saved for an emergency. So how could they foreseeably imagine building an investment portfolio? And with inflated costs left, right, and center, whether it's rent, food, non-discretionary items, it's getting tougher. So I want to phrase this as a question for you. If you were in that situation, living paycheck to paycheck with less than $500 saved and no real-world assets, what would your step-by-step process be to climb out of that cycle? And like walk me through what you do the first 30 days. How would you approach mindset? How would you navigate your necessary income and expenses, your available income and necessary expenses? What tools or habits you'd employ? Let's start right there. How would you dig yourself out, Darrell?
Yeah, I'm glad you asked this question because this was my situation back in 2020 when I actually got into financial media and started consuming the knowledge and things of that nature and just learning how to find my way. So first 30 days, I would say I would read the book, The Millionaire Next Door and Rich Dad Poor Dad. I mean, I think I just listened to the audiobook of The Millionaire Next Door, and that was about 4 hours. And then Rich Dad Poor Dad, I read that very quickly whenever COVID hit and I had zero in my bank account. And I think both of those books, what they did for me was really help me understand how to start accumulating wealth and the way to make it out of the rat race, but then also thinking about the habits of the wealthy and the rich. And so some of the habits of the wealthy and the rich, some of them are flashy, some of them aren't. Like even every year I go to the symposium, Rick Rule has the same outfit, on the cruise. And many folks that I've had folks come up to me at the symposium saying, hey, he wore that shirt last year, that. And I've been to, Rick's house. I've seen what he drives and everything. The guy is not a flashy guy. He shops at Costco, Kirkland brand and such. And he's even mentioned that on my show. And so just thinking about someone who has that amount of wealth, they're not in a consumption mode where they're consuming things that have no value. And so those are a couple things that I've learned from The Millionaire Next Door, as well as Rich Dad Poor Dad. There's a lot of access to financial media. I mean, just how much the internet is advanced and everything. People could just search how to start building wealth on YouTube, and many different videos will pop up. Now you are going to get your gurus and everything, so you do have to learn and ensure you're not getting into these traps of someone trying to sell you something and take the money, little bit of money that you are able to save. But really just start to consume the knowledge. So that's something that I would do, in the first 30 days. And then obviously setting a budget, a zero-based budget. So I'm eliminating all non-essentials. I'm not eating out. I'm canceling the Netflix subscription. I'm not drinking coffee. If I'm drinking coffee, it's Folgers out of a tin can and at the house, right? And those are some of the things that I would have to do, because you have to go through some type of financial detox. And just a little bit of my background, I've worked with folks coming out of the drug lifestyle and drug addiction and stuff, and having to go through detox and just seeing that how painful that process is. That's the same thing, very similar with the financial situation. So being able to save what you can, even if it's a few dollars a week, start buying small pieces of hard assets, even if you need to buy gold back, or if you need to buy a 1/10 ounce of silver, or a 1/10 ounce of gold or whatnot. There's ways that you can get started and you can start to accumulate wealth. And I think that for me, just to wrap this up, the benefit for me buying precious metals was that it was a lot harder to sell, rather than saving cash and putting it on a debit card, or having cash easily accessible. So I was able to accumulate a lot of value through precious metals, because one, I would either have to go to a coin dealer, or I would have to sell it online to the online community I was connected to at the time that I was buying and selling from. I have to package it, ship it, insure it. I had to go through all these multiple different steps to even spend the money. And oftentimes when I had to assess, like, okay, is this something that I want to buy? Is this something that I really need? Just thinking about the process of having to liquidate my gold really prevented me from doing that. So I think those are some of the steps that I would take.
Yeah. Okay. There's so much in there I want to pull on. And that point at the buzzer, gold, silver, both options on liquidity with a couple extra barriers, which are kind of annoying if you need that liquidity. But that's the point, right? Like half an hour ago, I ordered a speaker on Amazon. One click checkout. It'll be here tomorrow. It's so easy to spend money. The benefit, and I've done this, by the way, like I save in physical gold. And I have sold gold. I've called that option on liquidity before when I was in a liquidity squeeze about 2 years ago. It was like I wanted to buy this investment property in the town that I live in, but it was a hot market. I don't want to get in a bidding war with anybody. But there was a little brief window when rates were forecasted to rise quite quickly. Sellers were throwing properties on the market to get rid of them fast. If they knew they were going to have to sell in the next few years, they knew, let's get rid of it now before transactions slow down. And so it was effectively a seller in distress. I made a lowball offer, didn't think at all it was going to get accepted. No one's accepted under asking offer in this town where I live in like probably 15 years. Anyways, they accepted it like 6 hours later. And I had to close immediately, and I was short on cash. And so, and actually it was Rick Rule who taught me this, like becoming your own central bank. And I sold a number of ounces of gold from my safe. I actually wrote myself a promissory note. The duration of the loan was 6 months. I had to pay back the gold ounces borrowed plus a fee in additional gold ounces. So it wasn't interest based. It was gold ounce based. And,
Wow.
I did pay it back in 6 months. So that what's the outcome there? I was able to be my own bank. It was very empowering. I ended up paying back the gold plus a fee. So now I ended up with more gold in the safe. And people say, but wouldn't it have just been easier if you just had that in cash, right? And yeah, the answer is, of course it would be, right? Yeah, but there's massive utility in having barriers to big decisions like that, right? Or small decisions, like, because it's one-click checkout, one-click purchasing. It arrives tomorrow. It's way too easy to spend money, and that's fine. It's all good, right? I'm for it. But having some barriers that make you think critically about transactions, massively beneficial, man.
Yeah, and also like just to piggyback on something you mentioned there, we live in a very consumer driven economy, and there's a lot of things that are promoted to you, and to where you may want to spend money on things that you don't necessarily need, whether that be I think I saw recently an ad pop up for Disneyland. You know, their 100th year anniversary. You can get it on sale right now. You know, someone may just pull the trigger on that. They're like, "Oh, I got this cheaper." You know, because things are going to be promoted to you even more cheaper, and even for like the average person who may not have any wealth, like, you know, when you think about the paying fors, the all those different things where buy now, pay later, those are things that have you spending your future income that you're going to be getting, because then your money's tied up with what you couldn't afford paying for it now on a loan. And so having things like precious metals definitely helps eliminate some of those barriers.
Yeah, you know, as Dalio explains, debt speeds up growth now in exchange for slow growth later, right? So you can take the trip, buy the home, whatever it is today through leverage, but it'll slow down your production down the road. And, you know, I was thinking as you're explaining this, like the way I think about savings for myself is that savings is the gap between my ego and my income. Right. And most people have a bigger ego than their income, which means they spend more than they make. And that's why they continue to accumulate debt month over month, because their ego exceeds what they can afford. If you can keep your ego, Rick Rule, classic example, has said outright many times to me, I'll never be able to spend all the money I've made given my lifestyle. Like I'll die very, very wealthy because at my rate, there's no way I'll spend the money I've made. Very low, like small ego relative to his income, right? Big gap there. That's his savings rate. That's why wealth has accumulated. And, you know, it's tough, right? Because I know plenty of folks who don't have big egos, but they have low incomes and high expenses, and it's tough. They're in a bit of a pickle, right? But you know, even just starting small, like buying 1 silver ounce, you know, something like this, like it's accumulation over time. And I found that to be so empowering once I started buying physical gold, because I didn't really know. I did it because my mentors told me to, right? I saw them do it. And I was like, okay, I guess this is the smart move. I didn't really understand the value of having an option on liquidity, having a safe haven asset, having a store of wealth with zero counterparty risk, all this stuff. I was just like, they did it. They're way more successful than I am. I'll do it too. And as it acquires over years, right, suddenly you begin to feel a lot more empowered. And the true utility of owning physical, aside from liquidity options, is that it gives you a bit of confidence to know, like in the worst case market scenario or economic scenario, you've got a fallback plan. You've got something that is not correlated to any foolish CEO or Fed policy. It's your wealth. You've got it, and it's stealth. Probably no one knows that you have that. And that gives you the option to sit back and do nothing when things get chaotic, right? Like when markets correct aggressively or crash, you see all kinds of panic activity, right? People start panic selling and panic buying. They don't want to miss the dip, or they want to get out before it crashes. Like people just start thinking very short term and reactively. And I found that as I started accumulating precious metal assets, it gave me a lot more confidence to step back from the chaos and take my time. Because I was like, I can afford to do nothing, which is an option I didn't have 3 years ago, 4 years ago, before I started accumulating.
Yeah. You mentioned a really good point there with, you know, precious metals, especially gold being a bearer asset, which means, you know, that there's no counterparty risk. The government doesn't necessarily know how much you got or whatnot. So, you know, I was thinking about this when I had a couple friends of mine, and they had some huge medical costs. They had to get some medical treatment, and I remember just them telling me the numbers, you know, 93,000 in medical debt. And I was thinking, and you know, they were trying to navigate how to get out of this hole, right? And I was thinking, I said, how do you even get out of that hole? And then as I started accumulating wealth and gold and stuff, and I'm not saying that people shouldn't pay their bills or pay, whatever loans they take out, but really, if someone wants to come garnish my wages, like I got a safety net, at home that's gonna keep my value and be a store of value. So I just think that that's another important piece where, I mean, we live in a world where people get sued, people get, things get confiscated and things of that nature. And so if anything's tied to your social security number, they can come after it. So it's important to understand like the nature of gold in that way as well.
100%, man. It's a sovereign asset. And I think it's so important to keep a sovereign mind, and not just from a wealth standpoint. We talk about this in the show all the time. Like, what is true sovereignty? It's critically analyzing everything that is just offered to you and thinking, is this actually in my best interest? Whether it's a financial product or a food product or a school system, like, doesn't matter what it is. Like, think critically about that. Make your own decision. And the more you can detach from the tried and tested path, often, right, you end up making or seeing opportunities. And I mean, that's what we try to do in my household. Look, I was also struck when you talked about, you launched the podcast in like 2020, thereabouts, right? And you were doing this because you were trying to educate yourself, financial literacy, build your own financial literacy. And I launched my podcast for pretty much the same reason, right? I recognized that I had a network of investors who had been in the game far longer than I had and had made way more money, and I wanted to join them, right? And so I was like, I'm going to start a podcast where I can interview a money manager every single week and just through osmosis take their best ideas and implement those into my own portfolio. It was a very self-serving endeavor. I was like, I want to take your hard-fought lessons. I want to own those for myself, and I want access to greater deal flow. And the bigger my platform, the more people I talk to, the more things I'll see, the more opportunities I'll end up in front of me. So since launching the pod, Darrell, like what are some of your key principles that you've adopted, key lessons, and some of the hardest lessons you've learned along the way since becoming an investor in the sector?
The copper market, of course, is the biggest metal market on the planet, 200 to 300 billion globally of metal traded. Following majors around and picking up projects that they jettison can lead to great success in this business. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. If you want to learn more, you can find us at vizslacopper.com.
Yeah, I actually scared myself into launching a podcast. It was, I was listening to a lot of Peter Schiff at the time. I was listening to a lot of other folks and just really thinking about the risks of government debt and things of that nature. And I was having a lot of conversations with friends of mine, and the conversations were just going hours. And then I began thinking to myself that this is unsustainable. Like, my friends got kids and families and stuff. And I need to get this information out. And so I almost like scared myself into starting a podcast. But even just leading up to that, during the pandemic was a scary time for me. Like, I had zero in my bank account, the world shutting down, people losing jobs, all of those different things. And I had almost zero financial literacy. I say almost zero because I did, a friend of mine paid for me to take a Dave Ramsey course. So I took the Dave Ramsey thing and I got the fundamentals. But one of the issues was it's almost like, where you just cut something cold turkey. It's almost like folks that start the New Year's resolutions. I'm going to get the gym and everything, and you go so hard, and then you don't pace yourself, and then you end up just falling off, right? And so that was the same thing that happened to me. And so when the pandemic hit, having no savings and being a sole income provider for my family and such, it was one of those things where it was a wake up call for me. And so after reading Rich Dad Poor Dad, this completely shifted my mindset. And this book sat on my shelf for like 4 years. And ironically, it was a gift from my former landlord. And then I had the time to read it, so read it, started going down the rabbit hole and listening to a lot of folks like George Gammon and Lynn Alden and Rick Rule and Lynette Zhang, and then even credit to the influencers like yourself and Michelle McCory, Daniela Cambone, David Lynn, like just helping break a lot of the stuff down. Like, and so that's why I appreciate what we do, because we are able to break it down to the average person. So I ended up picking up a a side gig delivering groceries while I was working full time so that I could start accumulating wealth. Like that's like how passionate I was about like getting out of my situation. I'm going to pick up a part-time gig doing this to start accumulating wealth. And so, and as I did that, I was listening to a lot of podcasts, listening to a lot of interviews and such, and then, decided like, okay, I need to get this information out of here. And so, when I started the podcast back in 2020, I didn't know what I was doing. And, folks like Rick Rule came on when I had 100 subscribers, and so that was something that was very inspirational to me. And even thinking about, just being at his symposium 3 years in a row and just having a friendship with them, like it just shows me, okay, well, wealth shouldn't be a barrier to connecting with folks and giving back. And so, that's a principle that I've learned from him through that. And so I did have some other hard lessons as well, since starting a podcast. I mean, one thing which you and we've talked about offline is just the time horizons and market cycles. Those were some big learning curves for me, because there were times where I thought we were taking off, and you get a false start. Gold popped up to 2,200, then back down to 1,800. Right, it kept doing that. Uranium recently over $100, back down to 70. Right, and so. Learning the patience and nature of like the capital cycles, that was something that was really a learning curve for me, as well as understanding the difference between price and value. And like even with the uranium thesis, I believe in a uranium thesis 100%. And throughout the last few years that I've been following it, and even consuming Rick Rule's content as well as interviewing him, I've noticed like there was times on interviews where he would say, yeah, I think the equities are getting far ahead of themselves. I'm going to take some profits. And, you get some folks that, follow some of these interviews and they just make a jump to investment decision based off what someone says. And I was thinking about it, even recently, like Rick knew the difference between price and value. Like he knew that this was going to take a lot more time to play out, and these equities are getting farther ahead of themselves. And so he decided to take some profits off the table. And so that was some ways that I was able to even benefit during this current cycle as well. And so, and then learning things like buying in tranches whenever equities became undervalued. So those are some of the things that I had to learn along the way in my investment journey ever since starting the podcast.
I love that, man. And I want to pull on a thread there. You talked a little bit about the difference between price and value, and some people might be listening to that and saying, what exactly does he mean? So expand on that a little bit for me. What can you share, Darrell?
Yeah. So just thinking about whenever you are doing your stock valuations, whether you're looking at the company's financials and coming up with a projection of like, this is where the price of the stock should be based on the value of the assets that they hold. And you're able to determine if a stock is like undervalued or appropriately valued. And then, and with that, you have to consider the price as well. So sometimes, especially even in the uranium sector, there's times where, these equities would run significantly. And then thinking about it as a value investor, you're like, okay, well, this is getting way ahead of itself. The thesis hasn't fully played out. There's still a lot of red tape in the regulatory environment and such. And so you're able, like for me, I was able to like benefit from that by taking, some of those profits, saying that, okay, this is getting too far ahead of itself already. And so those are some of the things I think about when it comes to price and value. It's determining what is the value of the company. And then when you look at the price, is the price cheaper than what conclusion you come up with for the value? or not. And then also you have to be aware of, sometimes you get this market FOMO where the price exceeds the value. And you, in that situation, I take profits. And so, and
That's
that's what
like
I learned from Rick.
That's one of the biggest mistakes I see investors make, is blurring the lines between price and value, and not differentiating, right? And price. What is price, right? It's just like, it's kind of irrelevant. As Rick describes, we keep on name dropping him. It's like a floating abstraction, right? It's almost irrelevant. It is irrelevant to the value of the business, because the market is just a sentiment indicator. Effectively does not tell you anything about the value of the underlying asset. But most people don't even think about the underlying asset. And I know way too many investors who aren't really investing in companies. When you buy shares in a company, you're purchasing fractional ownership of a business. Hopefully that's how you're thinking about it. Most people are just trading share prices, right? Mm-hmm. Is the company over or undervalued? Well, they'll look at the share price and they'll look at a chart over the last year and say, well, relative to where it was priced 6 months ago, it's cheap, or relative to where it was priced 6 months ago, it's expensive. That's just comparing price to price, not actually looking at the value whatsoever. And if you're a long-term value investor, like most, if not all, highly successful investors in the mining sector, you have to have that long-term approach, and you have to understand the underlying fundamentals of the asset that you're buying fractional ownership in, right? Yeah. And if somebody were to ask me, like, what's the number one trait or ingredient in the most successful junior mining investors that I know, and myself included, it's duration. That's what it ends up being. And that's not, by the way, specific to the mining sector. That's just an investor indicator of success most of the time. Anybody who you look at and look up to in the market, I bet you they've been in the market a lot longer than you realize. And even, the GOAT, right? Warren Buffett, we all know his name, and he is the oracle because he's been in the market for 80 years. He started when he was a young teenager. He's still going in his 90s, right? Now, he's got a brilliant strategy, but if he had that same strategy and started when he was 30 and quit when he was 65, he still would have made money, lots, but nobody would have ever heard his name. It was 80 years of compounding. That's why he's Buffett, right? And it's the same reason that for most investors at the end of their career, if they reflect back on the highest performing asset they ever owned, it's never an equity. Almost all the time, it's their principal residence. It's their house. And that's because it's the one asset you buy and hold generally for 25 years. Duration wins. Before we hit record here, we were saying how long's Rick been in the market? This is his fourth bull market, like a long freaking time, right? He stayed in the game, never bet more than he could afford to lose, because that's the Achilles heel for most investors, right? They charge into opportunities, get seduced by promotion, or FOMO, as you mentioned. They bet more than they can afford to lose. They didn't do their diligence. They get caught flat-footed, wiped out, and they're off the table, right? Yep. Staying at the table is like rule number one. Rule number one, stay alive, always, always.
Yeah, for sure. And there's times where, like for me, in one of my investment approaches is to, whenever the price exceeds the value, is to take that profit off the table. And even if I have a longer term thesis on it, and I say this because we've had quite a few bumps in the road, even with uranium, like uranium equities. I can name a few. There's these macro events, Japanese carry trade that happened last year. I think it was August. You had the DeepSeek thing. You had the Liberation Day. And in many of those times, the equities retreated so much, and so for me, it's okay, well, understanding the longer term picture, but then also within the shorter term, understanding that there can be turbulence there as well. And so I'm always, kind of paying attention to all of that as well.
So let's talk about making some money in the market, because I want to make a bunch. Darrell, where are you putting your cash right now? What's looking interesting from a commodity standpoint or company stage standpoint? What's catching your eye?
Well, really, right now, I'm really have my eye on uranium. Many of the equities have they retreated to significantly low points after the Liberation Day, and in April, I went in buying. So buying when there's blood in the streets, and they've bounced back significantly since then. But with the executive order that was signed and the sentiment and the supply and demand and all of those things, like the thesis just keeps getting stronger. And now I think that there's a way for this trade to actually really start getting some ground made, especially with the reduction in the regulatory environment, as well as the AI data centers. That was something that came out of left field for me. I didn't even have that on my radar. Like, I already knew it was a supply and demand gap, and then the AI data centers started coming out. That news and the deals between, Microsoft and some of these other energy companies and stuff, like, those are things that for me, I wasn't even aware of. And so thinking about that, the uranium trade is something that I'm extremely bullish on, and I'm continuously looking for opportunities there, as well as gold. I mean, gold is one of my favorite things to invest in, as well as to store value. So I'm still accumulating physical gold now, even at these prices. I think the price of gold is going to go, well, gold measured in dollars. The dollar falls against gold, currencies fall against gold. But I think that what it's going to be priced in is going to be a lot higher within the next 5 to 10 years. I think that the deficits are going to continue to be blown out. There's so many tailwinds. Rates are suspected to be coming down, and geopolitical issues continue to arise, right? And so I just think that there's so many tailwinds for gold that I am super bullish on that asset. And so looking for opportunities in the miners, obviously, the gold has to come out of the ground, and you still have central banks buying. Western investors are starting to tick up a little bit, but Eastern investors are still accumulating at a lot more than Western investors. And so gold is something that I'm super bullish on. Then even silver is something that it's one of the assets that's still undervalued compared to the price of silver is still off the highs. And then silver not too long ago was at $30. I mean, now it's at $39, and so I think silver still has a lot more room to run as well. And obviously, the industrial side of that plays a role, but then you also have the monetary nature as well. So silver, gold, uranium, those are my things right now.
I love that, man. There's really interesting innovations happening in the nuclear sector as well, like both at home and abroad. And everybody tends to look at reactor production and forecasts for new reactors and think, how on earth is the United States ever going to catch up to China? And the short answer is I don't know. We're maybe at best case scenario 5 years behind from an energy production standpoint to meet the needs of these data centers that we all agree are so much of the future. But there's really cool innovations happening nonetheless. A company called Valor Atomic. Isaiah Taylor is the entrepreneur. They're based down in El Segundo, just south of LA, I believe. And they're building these very tiny, small modular reactors, like the size of a shipping container, right? And one of these reactors can power a town of about 25,000 people. And I understand that because I live in a town of 25,000 people, so I'm like, I get it. But they're rebuilding, they're attempting to rebuild the grid by not building, one reactor that could handle a city, but if your city is a couple million people, you just need a stack of these SMRs. And American engineers have become very good at building small things, but not really good at building massive infrastructure the way we used to. It's been a long time since America's needed massive updates in very large infrastructure, but the small stuff, Americans are still the best in the world at. And so, approaches like that, new angles to nuclear production and therefore uranium demand. I'm very excited about the energy sector right now. And I think we're just beginning to scratch the surface. Do you look at copper? Because, I often get in debates on my stage and whatnot with people about the copper picture and forecast. And here's what I find. I find two core opinions that I end up battling back and forth with. And I'm very bullish on copper as a consequence. And am right now allocating a bit of capital to that sector. Most recently, Vizsla Copper, Craig Perry's company. Craig's got an amazing track record.
Shout out Craig.
Yeah, shout out Craig. Serially successful entrepreneur, like one of the most, very well capitalized, like the Inventa Capital crew has great access to capital. Vizsla Copper is on the verge of a discovery. I believe it's definitely not advice. It's an early stage speculative company, but I like the looks of it and I like the looks of the team and I love the track record. But I hear two primary forecasts in the copper sector. One is that given our demands on the back of AI data centers on renewable energy, the copper demand is going to boom. Like we're going to need more copper than ever before. And this is going to cause a parabolic rise in the demand curve. And the bears would say, yeah, maybe, but in the interim, we're probably set up for a globally coordinated recession, and that's going to crush demand, actually. So we could expect that to fall off a cliff. And I tend to step back from that. And, you could look at copper demand decade over decade since like 1970. And what you'll see is a very consistent increase in demand of about 4 million metric tons, like 3 to 5 million metric tons every decade since 1970 to 1980, 1990, 2000, 2010, 2020, same thing. And the reason that's so important, like to step back and look at the big picture, is because whether we're forecasting globally coordinated recessions or massive technological disruption, we've also seen all of those things in the past and a few times in the last 50 years. Yet, what happened to copper demand? It's a very predictable 3 to 5 million metric tons per decade. We saw massive technological disruption, the smartphones, the urbanization of China. We saw these events. We also saw many market crashes and economic recessions. Despite that, the curve maintained if you step back at a long enough time horizon. The point of that is that I don't care. AI data centers, globally coordinated recession. I think our consumption, based on the last 50 years, is a better litmus test than what might happen in the next couple. And the most exciting part about that is you can look at production numbers over that same time period, and you'll see if we needed 7 million metric tons in 1970 and 8 million metric tons in 1980 and 11 million in 1990, that's what we produced. Production met demand step by step every decade until about 2015. And then a little gap opened up. And in 2020, that gap opened wider because we've starved new production of capital, but we still need the stuff. And so we're now entering that true supply gap where every year demand's continuing at that trajectory, but supply right now is flat and soon to fall. And that's going to open like an alligator jaw. And I'm super excited about that from the copper side.
Yeah, copper for sure. I'm into not financial advice. I'm into Ivanhoe Electric and as well as Vizsla Copper, and I think that how long it takes to get a copper mine going is a big issue, as well as when we look at the like you mentioned, looking at the metric tons over decade by decade and how much it took to really supply. Looking at the population growth, like that chart, when you look at the world population growth, it's bananas, right? And so I think that, we're going to need a lot more of copper, especially when we look at AI data centers and even just transmitting the energy to the actual data center, the grids, things of that nature. I think we're going to need a lot more copper.
100%. And as we continue to automate our manufacturing practices, the pie chart of what's required to manufacture a good always has a handful of things on it, labor, fuel, transport, input, ingredients, whatever that thing is. And as we continue to automate, that slice of the pie that says labor is going to get increasingly smaller. And the slice of the pie that says energy is going to get increasingly larger because that's how we're going to scale manufacturing in the future. And so, okay, interesting. Let me ask you, can you share anything about your positions in the gold sector? Like, you can name drop companies if you want to, or just like stage of company. What's the market right for right now? Are you looking at producers, junior producers? Are you down in the drill hole plays? Like where are you at, Darrell?
Right now, mostly in royalty and streaming companies. That's been my favorite model. I do have some positions in exploration and development as well, but not as much as the royalty and streaming sector. And so, companies like Ore Royalty, Wheat and Precious Metals, Gold Royalty, I just think that model and just how much, I mean, obviously when you get into this sector, like there's a lot of risk. And for me, I'm always a student of the game, and just learning a lot more. I mean, and so those are some of the things that I have to consider as well. So royalty and streaming, I feel like I know pretty well. And I do want to give a plug for Commodities University and Adrian Day, just put out, we just put out a royalties course on Commodity University. And I think that was pretty good. And so that's where I'm mostly positioned right now, just because I just love the model. I mean, being able to collect the royalty on the mines and what's produced out of the mines and such. And then obviously you can look at the assets and see what stage of development the asset is in, when is it going to start producing revenue and such, so that you can collect the royalty. So, and I like the streaming model too, being able to get the gold and whatever underlying metal at a discount. And so, and then I'm also in Nations Royalty. That was a recent one that I discovered at the symposium, and just understanding that model and what they're aiming to achieve. That was something that I could get behind. So that's the sector that I'm in.
I like it. Yeah, and yeah, a lot of those companies are like, I have in the Commodity University, thanks for that shout out. That's right. Adrian Day's masterclass in royalty and streaming companies just dropped. It's live now, thecommodityuniversity.com. And we do monthly meetups with the instructors, myself, and all the students. And what I constantly remind, especially the new investors to the sector, is like start with what I call your pillar positions, right? And those are the wheats and precious metals. Look at the speculative stuff. Like that's where you can make some serious money. It's so exciting. It's high risk though, right? And you can get smacked if you're not paying attention. And you will, even if you are paying attention. It's just, that's how that part of the game works. But hopefully your wins amortize your losses. That's the deal with asymmetric bets. But you need to go into that from a position of strength and confidence. And you can only do that if you've got a foundation in companies like the Agnicos, like the Wheat and Precious Metals. Yeah. My favorite royalty company in the game right now is Empress Royalty. It's like earlier stage.
Shout out. I figured I need to shout out Alexandra from Empress. Yes, that is a solid company. I position there too.
It's solid company, but they're early, right? And
early.
Valuation's cheap right now. Despite her doubling revenue every year for the last 3 years. Now, it's a small royalty portfolio. They have 4 producing assets, right?
Yeah.
One of them's in the U.S., unless they just brought on their 5th. But, you could maybe make the argument.
Closing the deal while we were at the symposium.
That's right. That's their newest American property. So it is a small portfolio and some, I don't know, like high risk if you don't know them, but some more questionable jurisdictions, more questionable than like, Australia, U.S. kind of thing. So there's a bit of potential volatility there, which is my advantage, right? I'm comfortable because I trust the leadership. Yeah. And I find her to be the beautiful combination of like incredibly patient and disciplined, but aggressive when the right opportunity strikes. And I think she got a lot of crap from shareholders.
Sharp.
What's that?
She's sharp.
Very sharp. Very sharp. Yes. And I don't think did a deal 2024. And a lot of shareholders were upset about it, right? But I was watching that and I'm like, no, it's like the alligator approach, right? Take one big bite, but be very specific about what you're biting at. Yeah. I learned about them in 2023 at the Royal Symposium and took a position then. I think the share price was at about 20 something cents. So done well then.
Yeah. So
I like that.
So that was Empress has been good.
You're up like 400%. I love that. And I think the party's just getting started. And obviously the bet you're making with these royalty companies is that they continue to mature, get to a place of consistent cash flow. They're the companies that are most likely to start paying a dividend. I have no idea what her plans are to pay a dividend, if ever. But my expectation would be she wouldn't pull that trigger until she knew it was something that the company could do sustainably, right? Like not start, stop, the kind of mentality.
I got a question for you.
What's up?
what is the significance of the acquisition of Sandstorm by Royal Gold in this particular sector? When there's a big acquisition like that, what does that typically communicate to investors in this particular sector?
Yeah, two things. I think Sandstorm was a company that was built in the worst part of the market, right? Like they came out the gate when the market was crashing, the junior mining market. I mean, 2012, 2013, and they were incredibly aggressive when everybody else was running away. And so the deals they got done will never be able to be done again, like not in the next 10 years, right? Nolan was very aggressive, very networked, very sharp. I mean, raised capital at the toughest time and put that capital to work when nobody else was. And so that's a portfolio that you're not going to be able to rebuild. So very valuable asset to be acquired. And secondly, I'd say it validates the thesis, right? Like we can all sit back, you and I can sit back, Darrell, and be like, yeah, bull market's emerging. We're now confidently in another secular bull trend in the commodity cycle. And we can point to the gold price, point to the silver price. We can point to, the best in class miners share prices hitting 52-week or all-time highs. But until you begin to see specific indicators like transactions, like new investors coming to the sector, that's what validates, right? Now I'm getting calls from Canaccord Genuity asking me about deal flow, right? Because they know we've been in the business before it was cool, right? They pivoted to tech for the last 15 years. Smart move. I stayed in mining. This is my home. It's my bread and butter, right?
Yeah.
And so now the phone's ringing. And I'd say it just validates the thesis, right? That's what it is. And so it gives me a bit more confidence that despite promised volatility in the future, promised it will occur, but the long-term trend is intact and the long-term capital allocators have been out there hunting. And, hats off to Nolan, such a sharp guy. He was on my podcast, 2 months ago in the studio there. We're going to have him back on, hopefully August, September to get deep into the mechanics of the deal. Cause I love picking them apart, when big transactions like that happen. Let's dive right into the mechanics. Validates the thesis and just gets me excited about the future. It's nice, seeing a bit of validation behind your convictions.
Yeah. Shout out to Nolan. He's came on my show before as well, and so him and Kim, if Kim's still with him, and so that solid company, solid dude, and I'm wishing the best success for them, especially in this deal.
I remember walking around the floor of the Mines and Money London conference in 2014, and he was walking around super young at that point and just hunting for deals, right? Because it was a tough year in the market. Anyways, I ended up having lunch.
You said 2014?
Yeah.
That was tough. That was a tough year in the market for sure.
Yeah, 2014, 2015. Yeah, man. And but I had lunch with a bunch of investors that I just met there, and I guess he had taken meetings with them the previous day, and they were just going around the table like, who is this kid? This kid is sharp. And just, I didn't know who he was, but this name kept on popping up over lunch. And every institution and high net worth investor he had met with that was at that lunch name dropped him and just said, watch out for this kid. It's cool when you see those things occur, right, and then materialize, got a lot of promise. Because there hasn't been a lot, it's like one of our jobs, Darrell, I take this very seriously, is to find the next generation of high-performing entrepreneurs. And, Rick Rule has shared this with me many times and on countless stages, I'm sure, that he's made a lot of money in this business, but if he had only ever invested in the top 3 or 4 entrepreneurs over the duration of his career, he would have made 100 times more money and worked 10 times less hard. And he means if he had consolidated all of his bets on Bob Quartermain, Lucas Lundin, Ross Beatty, just a select few, and our job is to find those people of this industry, right? But our generation of them. And quite frankly, it's been very hard over the last 15 years because there hasn't been a lot of wins or serial wins in the industry because the industry has been in the gutter, right? But there's been a handful of names to watch, right? I have maybe 30 people that I watch in the sector. And by the way, when I first started investing in this industry, going back to 2010, my first move was everybody seemed to say like, bet on the people, bet on the people, bet on the people. And so I created a list of about 30 names, created Google alerts for all of them. And so whenever anybody's name, one of my 30 list names got mentioned in a press release or in news flow, I'd get an email about it. So I'd see, what Eric Sprott was investing in, whether Justra was in a deal, what Tom Kaplan was doing, and then I would just, limit my view to their ecosystem, right? What are they in? What are they looking at? I figured I'd be in safe hands if I stuck with the best names. And to a degree I was, but it was a tough market. So it was sort of hit and miss, to be honest with you. But, I've generated probably about 25, 30 of the next generation that I'm like, not proven yet, but very curious, and it looks really good, right? And Michael Connor's one of them, right? Who is Craig Perry's business partner at Inventa Capital, a guy who financed Vizsla Silver, payroll and business expenses from a personal credit card and line of credit, like when he was getting the company started back then in Mexico, you know? Yeah. And that's like a demonstration of the culture at Inventa. Like they'll do anything to get the job done. Those are the kind of guys you want to bet on. And watching his trajectory now that the market's kind of emerging and ripe is like, I think that's a guy who I'm sticking with, will continue to bet on, and have very high hopes in the future. Alex Whittier-Sharon's another. Incredibly disciplined, incredibly patient, but aggressive when opportunity strikes. Very well networked, very well capitalized, built incredibly intelligent capital partnerships. So has Michael Connor. So has Ivan Bebek, another guy who's got sort of 2 wins, right? 1 mine, 1 acquisition. He needs the third, right? He jokes with me. He's like, you get 1 win and people think it's a fluke. You get 2 wins, you get people turning their heads and paying attention, but you need 3 to really prove your point. And I love that, right? I love a guy who can have a couple massive wins on his track record and still feel like he's got this big chip on his shoulder because he's got something to prove. Those are the kind of entrepreneurs you want to bet on, right? The individuals who just are up late stressing out about not being successful enough yet.
They working a lot more hours than I'm working. So shoot, they got to know something more than me.
Yeah, right. Right. Look, man, I'm pumped to have you on the show, Darrell. I'm really excited, and VRIC Media is in a very exciting place right now. It's the only platform in the mining business that is truly built by junior mining investors for junior mining investors. We talked a little bit about like the biggest mistakes investors make in this business. And I'd love to know if there's any that stand out to you, but one of them that stands out to me, and I share this on your podcast, New York University recently did a study where they analyzed about 3,000 investors and the activities and habits they had. And they determined that the average investor, before buying a position in the company, spends an average of 6 minutes doing research. And the average investor utilizes 1 resource before making that decision. And so what does that really mean? It means they have no framework for decision making. They're just seduced by company promotion, and they get pulled into whatever idea happens to land on their desk. But they don't have a framework for decision making, right? And like in the Commodity University, we have a worksheet we use for every position we buy. There's 3 to 5 reasons at the top. Why am I buying this stock? There's 3 to 5 catalysts for growth. What do I expect to happen in the future that will increase the value of this company? There's 3 to 5 red flags that might emerge that would cause you to sell. There's a documented time horizon. I intend to hold this company for 3 years. That helps you stomach the volatility if the share price corrects by 20% in the next 3 months. Shouldn't matter if your thesis is still intact. 3 years.
Yeah.
And then like we all need sources of information and research. We all need, you mentioned gurus. We need gurus we can trust, but how do you differentiate between the valid gurus and the charlatans, right? Like it's tough, And what I tell people is like, there's 2 things you got to do. Number 1, you got to find information sources that you enjoy learning from, like people who communicate in a style that resonates with you, because if it does, you're going to keep going back to the trough. And if it doesn't, you're not going to, and then nothing's going to compound. You got to find people who you enjoy learning from. So you go back daily or weekly, because you could read one of our newsletters and learn almost nothing. Well, hopefully learn something, but you could read every one of our newsletters for 6 months. You're going to learn a lot, right? Because you're going to understand how we at Cambridge begin to like think about risk, identify angles, and interpret the market. And then you can take whatever works from you and discard what you don't. But you need to find sources you enjoy learning from. But obviously that's not enough, because the best communicators are often just the best salesmen, right? And there's not a lot of substance behind the curtain. So how do you validate that? And you got to look at, look at track records. But it's, it's more than that. You got to find people who you can trust. And the only way to do that is like spend enough time with a pundit, journalist, content creator. You begin your spidey sense will just sort of tell you eventually, can I trust this individual? Do they put their money where their mouth is? Are they actually an investor, or are they just making money off me? Right.
Exactly.
And important to be able to determine, like, how is this journalist getting paid? If you can't determine that, it's a bit of a red flag, right?
Yeah, for sure. Yeah. And another plug to Commodity University, even the team here, that helped put that together. I think the way that the university broke things down for people to understand was amazing. Like, and I think that's transformational. And so some of the specifics, just even in your the mining 101, just even explaining, like, for new investors that are coming into the game, what's an inferred versus indicated versus measured, what's proven and probable reserves, things of that nature. Like, these are some of the things that new investors are coming in and even for like when we go to these symposiums, you go to a corporate presentation or whatnot, some people may have questions like, what the hell does this mean? Right. And so, like, the Commodities University definitely helps people understand that. And so I really appreciated the level of effort that was put behind that.
Oh, man. I love hearing that. And that was the point, right? Like, it's so easy to be lost in the complex vocabulary and concepts and think this is way more technical and challenging than I thought it was going to be. Trust me, It isn't. Like, it's not. And I don't mean to be offensive, but I say that from the standpoint of, like, I'm in the people business in this industry. We get 9,000 people at my conference, 100 keynote speakers, podcasts, same thing. The people in the industry are not nearly as smart as you think they are. Like, you know what I mean? It's way easier to understand than you may think. And so the whole purpose of the Commodity University was to demystify the sector and make it really easy to understand. When a CEO is throwing some complex jargon at you, you can smell bullshit right away. And it doesn't take much. That's it, right? Understanding, just getting familiar with the terms. What is the difference between inferred, indicated, measured, resource? What's the difference between a resource and a reserve, right? It's like, well, one's geology, right? There is rock beneath the surface. The other is economic, right? We can get that rock out for profit, right? That's the reserve, that's the resource. But little things like this, and just becoming familiar with the terms, then when you hear a company pitch, then when you read a press release, then when you look at a company website, you're going to understand with a lot more clarity what you're reading. And the benefit to that is when you read company B's website, you're automatically going to intuitively draw comparisons, and you're going to know back to price versus value, right? This company is very overpriced relative to what they actually have in the ground, given what this company has and where their price is, right? There's a disparity here, and that's our opportunity to find those mismatches of value and price in the market, because investors got sold on a promotion or a marketing campaign and piled into company A when company B has the better resource and the share price hasn't appreciated yet, but eventually it will. That was the purpose. TheCommodityUniversity.com. This was not intended to be a promotional episode, but I love it.
It's providing value.
Look, man, I'm pumped to have you on board. Anything else you want to share with the audience, Darrell, before we wrap this up?
Yeah. Just looking forward to engaging with more of the guests that we have coming on the show. Excited for some of the guests that we have coming up, and being able to really pull out some of the valuable information that people want to hear. And so, that people need to hear and want to hear, and I think that that's important for us is as we're interviewing the guests, is being able to kind of be that translate, that kind of mediator, even if there's information that's spoken of at a high level. That's what I do on my show, and I'm happy to bring that to VRIC as well. That's something that I've seen you do, just being that mediator between, like, okay, we're receiving this complex, what may seem like complex information, but let's bring that down to the basic level for those that may be watching, that may be new investors that want to get into the sector and stuff, so that they're able to learn and grow as well. So I'm excited to bring that to the channel, excited to interview some of the guests and engage with the audience as well. So
Can't wait, man. Okay. Thanks, Darrell. I'll look forward to the first episode, man. Check out Darrell Thomas, VRIC Media, coming soon.
all right, see y'all.